Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. This segment is brought to you by CommercialAgentSuccess.com. Check it out for incredible training for commercial agents at CommercialAgentSuccess.com. Well, today we're looking at the Fed's view on commercial real estate. We have Brian Bailey here in Studio One. He's the Atlanta Federal Reserve's commercial real estate and real estate guru. And Brian, thanks for being with us. And in the previous segment, we talked about some things that are kind of impacting the market. And, you know, interest rates have been low a long time. We've seen, especially in some markets and some sectors, pricing get pretty high. Are we in a potential bubble from the low interest rates? Is that something we should think about if 3, 4, 5 years down the road, interest rates start to rise?
It's a great question, Michael. Mm-hmm. And I think, you know, first of all, you know, it's very difficult to identify a bubble. If, you know, let's look back a decade, and you know, would you have said, you know, in 2005, 6, and 7, you know, the retail, you know, is in, you know, some form of heightened dynamic at that point, and then you transition to today, and it seems that, you know, our friends in the press, you know, retail and the apocalypse are, you know, kind of linked as far as the headlines are concerned. And so first of all, I'd say very hard to define, you know, a bubble and identify whether one is happening. Certainly, we've seen, you know, more appreciation generated because cap rates have come down compared to, you know, NOI growth in a lot of instances. And so I think, you know, we have to be aware that going forward, if, you know, the climate changes and debt service were to rise, interest rates were to rise, you know, big if, but if they were, you know, certainly that puts, you know, is going to put more strain on the, you know, financial feasibility of some of these projects.
Yeah, I mean, it's kind of interesting. I think I look at a deal I might be selling at a 5 cap today, and I think about exit cap rate in 5 years. And I think, you know, as a broker that's been around a long time, I think it'd be hard to tell a buyer that expect a 5 cap 5 years from now, thinking that hopefully interest rates have come back up a little bit, and it may affect.
But you look back to, you know, 5, 6 years ago when, you know, cap rates were compressing, and you know we've essentially had a form of this conversation all the way back to when, you know, I was in the private side of the business, you know, 10, 15 years ago. I mean, we saw cap rates come down, and we all thought, gosh, it's the time to sell. Mm-hmm. And you saw momentary, you know, a little bit longer than that associated with a downturn. But I mean, cap rates have come back down to those levels that we saw in 2006 and even surpassed those.
Yeah. Well, it's funny you mentioned the kind of the pre-recession days and how we're looking at the market. And I've told several people this: if you're talk to people who are not in real estate, tell them this: look, if you're at a party and everyone there is talking about all the real estate they're buying and the homes they're flipping and stuff, it's time to sell, okay? And everybody's talking about the woes of real estate and how it's terrible. It's time to buy. That's my advice to tell the non-real estate people. Of course, the people listening to our show are more experts. And, you know, so one of the things that we consider about the future is what about volume for lenders and transaction volume? You know, what do you expect moving forward?
As far as loan volume is concerned, just to make sure I'm clear on that.
Yeah.
So, I mean, I think that, you know, we continue to see, you know, the availability of capital in the commercial real estate space. And so I think that, you know, what I'm hearing is that the availability of capital is plentiful. There are some deals that are being scrutinized a little bit more compared to times in the past. You know, right now, limited service hotels have kind of piqued curiosity. We're building a lot of them. We're, you know, also, you know, they've been a sector that kind of has been, you know, good times or bad times. We saw a lot of them that went back to various institutions during the downturn, and so and that is because of the structure. I mean, it's a single night, generally a single night lease, and harder to forecast revenue. And potentially, it is tied to consumer spending. And if the consumer decides that they want to spend their money other places, or if there's a dynamic that causes the consumer to pull back, then that's certainly one of the areas to feel that first. I think the other area that we're hearing, a little hesitation around is certainly some of the retail assets right now. And you talked about if you're hearing a lot of talk about the woes of retail, it's time to buy. Certainly we've seen some folks that have gone in, some firms have gone in and made purchases. They've got the expertise to kind of navigate, in my opinion, they've got the opportunity to navigate some of the changing dynamics in retail. But certainly I think, those two areas, certainly have, some questions around them. The other thing I think right now is, just from a supply standpoint, we've built a tremendous amount of luxury apartments. And, how deep is the group that will fill those apartments? And certainly it's a question. Additionally, price continues to rise. At the same point, as they're coming online, more concessions are being offered. And so, are those apartments, hitting kind of their financial hurdles that were initially represented to the initial investor, as well as, if an institution has been involved in the financing, or some of the questions that we've been doing some research around.
Yeah. Well, and I see that in the marketplace as well. We have a hotel group that sells hotels, and we do sell some limited service hotels, and there's still a lot of demand from buyers and sellers, and in our retail vision, we're selling. When we put a retail property in the market, we get tons of activity. So, and I think part of it is people looking for returns, right? They realize if lenders are a little more concerned, there's concern in the marketplace and especially in the press about retail. Maybe there's some opportunities for redevelopment, and as you say, repositioning. So it's interesting to look at what lenders are looking at, what they're concerned about, and how it impacts the market, and how it impacts opportunities out there. And one thing you mentioned is cost to build new, the construction cost, and it seems like construction costs have a lot of dynamics. They're really impacting the market. How do you guys look at that, and where do you see it impacting the market the most?
Well, yeah, I mean, to give you some facts, one of the largest construction firms in the U.S. shared some information with us where they said across the nation that in 4 of the last 5 years, construction costs were up over 5% each year. That's a pretty big number.
Yeah.
And certainly, my response is, how fast is NOI growing? How fast are your rents growing? Are they growing at, a comparable or a rate that exceeds that? Yeah. And I think in a lot of instances, what the feedback I'm getting and the data I'm seeing is the answer is no. And so, then you begin to wonder, well, what does that mean? Does it mean that, more projects are slower to get started as far as new construction? Does that mean that we begin to kind of whittle down in some of the other areas? We sharpen our pencil and we say, gosh, I can't get this project started unless I'm more aggressive with the underwriting, or I need more interest only. Some of those dynamics. It's a little bit of a trade-off in some of the other areas, and so certainly, we're watching that pretty closely, because I think rising construction costs, have so many implications, not only on new construction and construction jobs, which are hugely important for the economy, but also for the space that's in place. Yeah. And do we have enough space and the right space to fit the needs of the marketplace as it's changing today?
Yeah. Well, it's really interesting, Brian. I mean, when you look at 5% increases, maybe you're underwriting a deal today as a developer or a lender for new construction, and you're looking at, by the time you start building it, it's 2 years. You got a 10% increase in your costs. That's pretty crazy, and how that could impact you.
Absolutely, and I mean, we know that pardon me for interrupting, the availability of labor is a huge component of that as well. And so certainly, not only, cost rising, but then, having the, skilled folks who are able to, make that construction possible.
Yeah. And when you look at the cost of new supply and the construction costs rising, how do you think that impacts kind of commercial real estate values overall? People like to get properties under construction costs, right? And because you figure out, well, if somebody had built something to compete with me, I should spend a lot more money than I can beat them to the market, right, on price. Is the rising construction costs, has it slowed new supply? And in some cases, is that really good for the safety of our lenders?
I think, to answer the first part of your question, absolutely, it has slowed new supply. I mean, you look at where, take office space. You just mentioned office space. We've really not, as a nation as a whole, we've built just a fraction of the new office space compared to, expansions in the past. Yeah. I mean, this expansion, I looked at the state of Florida the other day, and really they've built about 5% of the stock in this expansion, which is minimal compared to what you saw, historically. Yeah. In a lot of instances, in the mid 2000s, they were building, 3% a year of the existing stock. So to put it in perspective, much smaller amount.
Well, no one's working in Florida, Brian. They're fishing and scuba diving and surfing.
Well, I spent many years in Florida, and I could tell you that maybe there was some playtime, but there were also some folks working pretty hard trying to make that happen. I think the question about the safety and soundness of the financial institutions takes on a little bit different perspective, because as we're being more efficient with our space. I mean, really, that's the other dynamic that's kind of been under the radar screen. Mm-hmm. I mean, we watch the potential for oversupply, and really, outside of a few areas, modest. But what you're seeing right now is, greater, efficiency. And so you take office space and you say, gosh, the amount of square footage per full-time worker has come down from 250 square feet in the early 80s to roughly 210 square feet today. We still know that that's not what is truly happening for the new companies. The tech companies are aiming for 125 square feet, give or take. And so certainly we know that potentially there's a bunch of space that may be obsolete. And how does that change? The lending dynamics. And so I think, you see commercial real estate shifting because of technology, and efficiency is becoming, a bigger and bigger component. I mean, essentially that's what's going on in retail right now, because, Amazon has figured out, hey, if we take the stuff to your house, if we put it on a UPS truck that can deliver 20 parcels compared to, having, 20 people out on the road going to the shopping center, it's less costly. Also less people out on the road, less time constraints, et cetera. So significant gains, I think, are being made from the efficiency standpoint. How does that change commercial lending is a question in my mind. Are the lenders looking at that right now and saying, gosh, technology is accelerating functional obsolescence in a number of spaces? Example, office buildings. In the 90s, before the 90s, everybody had hard-walled offices. They were 300 square feet per full-time equivalent or 250 square feet per full-time equivalent. Now it's all open floor plans. Mm-hmm. And so certainly if you have those buildings that were geared for 300 square feet per worker, and now they're being used at the more intense rate of 100 square feet per worker, what does that do for HVAC? Mm-hmm. What does it do for life safety, elevators? You're going to use those items much more intense, which means they're going to wear out faster. Yeah. The other thing we know, construction costs having gone up, we know the fit out are much higher. Right. And so I think, then you have a question, if you're an owner operator, I know at some point I'm going to have to come out of pocket with a lot of dollars to rehab this space or bring it up. And sometimes that decision can be harder because those numbers are so expensive.
Yeah.
And in some instances, I'm aware of a few examples where the owner, even though they were current on their loan, decided not to make that investment, and they turned the keys in to the lender, which certainly is a dynamic we have not seen in years past.
Yeah, and you mentioned a lack of new supply, this new supply levels are extremely low, and there seems to be a lot of investors around the world they're kind of looking even at real estate right now and thinking, hey, if we do hit a recovery or a soft market economy, real estate is safe. Is part of that because of the lack of new supply? I mean, if we look at the past recession we had, there was a lot of building, a lot of overbuilding, and it seems like every recession I've seen or downturn, there was this kind of overbuilding mentality. It seems like we really haven't had that. Does that create a bit of safety in the commercial real estate equity or debt world?
I think from a supply standpoint, the answer is yes, though I would say there are probably a few sectors right now that may pose greater risk. I mean, you think back, strip retail was synonymous with overbuilding. We consistently overbuilt it through a number of expansions. And I think, we're seeing, again, some of the efficiency take some wind out of retail sales. The other question I do wonder is, with all of this luxury multifamily, certainly we have built very little affordable multifamily, and so where would the folks go? But certainly from, just a vast amount of supply, we've built a significant amount of luxury product and at very high prices.
Yeah.
And so certainly if you were to hit, some kind of slow patch, that may put, added pressure not only on those owners, the residents, but also, the lenders behind some of those deals.
Yeah. So back to your example of properties that kind of lenders may be watching out for investors, the limited service hotel, some of the retail, and some of the luxury multifamily. Well, Brian, what would you leave our audience with related to the future of the commercial real estate world, at least the immediate future ahead of us?
You're really trying to get me in trouble, aren't you? I think right now, we're fortunate in that commercial real estate lags the overall economy. So, I would say that dynamics are better in the commercial real estate space than the overall economy, though things are not bad in the overall economy. I mean, we continue to create 130, 140, 150,000 jobs a month, and that's more than we need to keep up with population growth. And so, as long as those dynamics continue to remain, in force in the economy, I think that commercial real estate will continue to benefit. At the same point, certainly as we're seeing some slowing, it's time to make sure that your financial house is in order. I think we know that in the last downturn, one of the lessons learned was that the borrower themselves, if they were disciplined and right-sized the amount of financing that they felt that they could undertake, those borrowers tended to perform better and had less distress than borrowers who took every dime that they could get out of the out of the financial institution.
Right.
So
and overall, you're seeing a lot less debt. Loan-to-value ratios are a lot lower than they were in the past, right?
Well, I think that
before the downturn.
I think on the surface they are lower,
Yeah.
but at the same point we talked about underwriting misses, which would push up some of those loan-to-values. And so I think that it is at a more muted level, more modest level than what we've seen in the past. At the same point, I do think that the actual number is somewhat north of there.
Yeah. Well, Brian, thanks for joining us. Great information.
It's great to
sir.
be here, Michael. Thank you so much.
Thanks for being with us, and thanks for watching and listening. Thanks for sharing the show. Hey, we'd love to have your comments and connect with us on your favorite social media. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com. Commercial Agent Success Strategies. Incredible training for commercial agents. Visit commercialagentsuccess.com.